Today, let's understand about single candlestick patterns. Now, before we jump into learning about different candlestick charts, there are few assumptions which need to be kept in mind that are specific to the candlestick chart. Strength is represented by a bullish or green candle and weakness by a bearish or red candle. Now, one should ensure that whenever they are buying, it is a green candle day, and whenever they are selling, it is a red candle day. The textbook definition of a pattern states certain criteria, but one should consider that there could be minor variations to the pattern depending on certain market conditions. One should look for a prior trend, that is, if I'm looking for a bullish reversal pattern, then the previous trend should be bearish, and if we are looking for a bearish reversal pattern, then the previous trend should be bullish. The candlestick patterns can be divided into single candlestick patterns and multiple candlestick patterns, meaning two or more than two candlesticks would be part of my candlestick pattern. Now these candlestick patterns, they can be further divided into bullish reversal patterns, bearish reversal patterns and continuation patterns. Now the first type of single candlestick pattern that we are going to learn about is the Marubozu candle. The Marubozu candlestick pattern is a single candle formation that represents market's resolve to move mostly in one direction without significant resistance from the opposing side. This eventually causes the candle to close at sessions high or sessions low. Marubozu candle, it comes in two different variants. One is your bullish Marubozu and the other one is a bearish Marubozu. So how do I identify a Marubozu candle? First and foremost, it will have a large real body and then there will be no shadow at either sides of the candle. The Marubozu candlesticks can be found on all stock charts and all time frames. Depending on who controlled the day, they can either be bullish Marubozu or bearish Marubozu. The color of the candlestick shows that either the sellers or buyers have full control of the market. Before entering a trade, it is advisable for you to wait for another confirmation pattern or candle. The absence of lower and upper shadow in a bullish Marubozu indicates that the low price is same as the open price and the close price is same as the high price. Therefore, when you see a candle with open equal to low and close equal to high, then that candle is called a bullish Marubozu. And similarly, for a bearish Marubozu, I can say that when the high price is same as the open price and when the low price is same as the closing price, then that type of candle is called as a bearish Marubozu. Now, this kind of candlestick shows that there is so much buying interest in the stock that the participants are willing to buy the stock at any price during that particular trading session. If the bullish Marubozu is shown at an uptrend, this strongly implies trend continuation. Now here in this picture you can see that there is an upward trend ongoing. We encounter a bullish Marubozu and hence this indicates a potential continuation of uptrend, and that is exactly what has happened. And these type of bullish Marubozu which allow the trend to continue are called as trend continuation bullish Marubozu. However, when this Marubozu, it appears at the end of a downtrend, it will potentially cause a reversal of trend, and that's why these type of Marubozu that cause trend reversal are called as trend reversal bullish Marubozu. Similarly, if the bearish Marubozu is shown at a downtrend, this strongly implies trend continuation. As you can see in the picture, there's a downward trend. We encounter a bearish Marubozu and the downward trend continues further. That's why this bearish Marubozu is called as trend continuation bearish Marubozu. However, when these bearish Marubozu they appear at the end of an uptrend, this will potentially cause a change in trend, or it will cause a trend reversal, as it has happened over here. There's an uptrend ongoing. We see a bearish Marubozu which reverses the uptrend into a downtrend, and that's why this type of bearish Marubozu are called as trend reversal bearish Marubozu. Now, how do I understand where to mark my entry and stop loss for bearish and bullish Marubozu? Let's have a look. First, entry and stop loss for bullish Marubozu. So if you recall definition of bullish Marubozu, then low is equal to the open and high is equal to the close. Hence, whenever open equal to low and high equal to close, a bullish Marubozu is formed. Therefore, the buying price or entry price should be near the closing price, okay? And the stop loss should be marked at the open price of Marubozu. In case if the market sentiment changes and the trade does not go as per your setup, then learn to accept the stop loss and exit the trade if low of Marubozu is breached. Similarly, entry and stop loss for bearish Marubozu will be explained over here. So for bearish Marubozu, open is equal to the high and close is equal to low. And in this case, what I'll do is I'll mark my buying price or entry price near closing of this bearish Marubozu. Over here would be my entry, and stop loss should be at the open price of Marubozu, so that if the market sentiment changes, then I can accordingly exit the trade if it does not go as per my plan. So that's all about bearish and bullish Marubozu. Now the next type of single candlestick pattern is spinning top. A spinning top looks like the candles shown in the image, meaning the candles have a small real body, and since they have a small real body, we can say that the open price and close price are nearly the same, and that's why we can say that since the open and close points are near to one another, the color of the candle does not really matter. So it could be a green candle or a red candle. The key thing to notice over here is the upper wick and lower wick of a spinning top would be nearly the same, or the upper shadow and lower shadow would be nearly the same in case of a spinning top. And this presence of upper and lower wick, it indicates that the bulls and bears were not able to achieve upward or downward movement respectively, or in simpler terms, I can say that there is an indecision situation in the market. Now let's understand the behavior of spinning top in uptrend and downtrend. First and foremost, spinning top in downtrend. Since bears are in control, we can say there is an ongoing downtrend. So spinning top formation would mean that the bears could be consolidating their position before resuming another round of selling, which in other words would mean there would be continuation of downtrend. Or I can say that the bulls are trying to prevent a further downfall of the prices, but they are unsuccessful. So exactly the same has been depicted in this picture. So since there is indecision situation, we can expect one of the two outcomes. That is, there could be another round of selling as shown in the picture, that there is a downtrend. We saw spinning tops, meaning that the bears have consolidated, and that's the reason after a slight upward movement, there is another round of selling causing a further downtrend. Or the second situation is, here if the bulls have consolidated well enough, then they could potentially reverse the market direction and we can see an increase in the price, or in other words, we can see an uptrend. So again, an indecision situation indicated by a spinning top. Now let's understand how the behavior would be when the spinning top is seen in an uptrend. So it will have more or less the similar outcome as the spinning top in a downtrend, meaning that whenever there is an uptrend, we always say that the bulls are in control of the market. That is, they have been dominating the last few trading sessions, and that's why there is a uptrend. And the moment you see spinning tops, we can say that the bulls are no longer in control, and that's the reason we see spinning tops getting formed in your chart. So here, with the formation of spinning tops, the bears have made an entry into the market and they are trying to reverse the direction, but they are also unable to do so. So, because of this indecision situation in the market, neither the bulls nor the bears can influence the market. So again, there could be one out of two things that would happen. That is, either the bulls could be consolidating their position before initiating another round of up move or uptrend, or the bears could reverse the direction and begin a downtrend. So here in the picture, I can see there is an ongoing uptrend. Spinning top formation has been seen. Here the bulls consolidated their position, and that's why we can see a continuation of uptrend. Now, how do I trade using these spinning tops? Now, spinning top, they have a small real body, which means that neither the bulls nor the bears could establish any influence on the market, and hence there is indecision or uncertainty in the market. So traders should look for the preceding market trend. So we should understand whether the previous trend was an uptrend or a downtrend. So if there has been a prior downtrend and you see a spinning top, then you can plan for a long position expecting an uptrend, with stop loss being marked at the lower wick or lower shadow of that particular candle, or at the lower shadow of your spinning top. And if there is an uptrend previously and you see a spinning top, then you can plan your trade expecting a downward trend or expecting a down move, and with the stop loss being marked at the higher shadow or the upper wick of your spinning top. Doji candlestick pattern. Now, a doji candlestick or a doji is a pattern that is formed in candlestick price charts, wherein the opening and closing price of a security, share or stock is equal or show very minute variation. The doji candlesticks derive their name from the Japanese term doji, which means a mistake or error, referring to the rare chance of a stock or share having an equal or almost equal opening and closing price. The doji candlesticks are principally considered neutral signals that reflect the state of indecision existing in the market. So doji candlestick patterns are of three main types. First one is a gravestone doji, which looks somewhat similar to an inverted cross. Then there is long-legged doji that looks more or less like a plus sign. And then there is dragonfly doji, which looks like a T. Now let's have a look at the dragonfly doji in detail. So dragonfly doji is a T-shaped candlestick pattern that can signal a potential reversal in price to the upside. Now again, this will depend on the previous price action. So always check for the previous price action before making any buy or sell decision. So this dragonfly doji is formed when the asset's high, open and close prices are all the same. The most important part of dragonfly doji is the long lower shadow. The long lower shadow implies that the market tested where demand was located and price was again pushed back to its original opening. So here you can see there is a downward trend, then a dragonfly doji formation was seen, and then there was an uptrend observed. So as stated in the second point, here the candle opened at this level. There was a downward movement and a demand zone was located, which pushed the price back to its opening level, rendering formation of a dragonfly, and then there is a upward movement seen. So doji is a category of technical indicator pattern that can either be bullish or bearish. But the dragonfly doji is a bullish pattern that can indicate a reversal of a price downtrend and start of an uptrend. So here there was a price downtrend ongoing, dragonfly doji formation was seen, and then start of an uptrend was initiated. Now though this indicator is seen as an initiator of uptrend, but there are few limitations of dragonfly doji. Let's have a look at them. So although the dragonfly doji can indicate coming of a bullish price change, traders should not rely on this indicator alone. True dragonflies are very rare since the open, high and closing prices are rarely ever the same. Successful traders will typically wait until the following candle to verify the possibility of an uptrend after a dragonfly, and if the dragonfly appears after a pricing uptrend, it can indicate that a price decline may follow. Last but not the least, a dragonfly accompanied by higher than usual volume is more reliable than the one with low volume. So these are the key characteristics of dragonfly doji. Trading with dragonfly doji. Since dragonfly doji is a bullish pattern, key thing to note while using this pattern for trading is the presence of prior downtrend. So here what we can see is the open and close prices of doji are nearly the same, and that's why my entry price should be nearby to this thin body of dragonfly doji. And talking about stop loss, it should be at the lower wick or lower shadow of dragonfly doji. And last but not the least, it is advisable to use this indicator in combination with other patterns or indicators to get a more successful outcome. First one is hammer. Now the hammer candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downtrend. A hammer shows that although there were a selling pressure during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Now inverse hammers. This would look something like this, which is similar to an inverted image of a hammer. A similarly bullish pattern. Now the only difference here, it would be that the upper wick is long while the lower wick is short. Okay. Again, it would be formed at the bottom of a downtrend. So there is a downward trend indicating there is a high selling pressure. Then we see an inverse hammer, which means that there is a buying pressure that will now come into play. So there was a selling pressure, but it was not strong enough to drive the market price down. And the inverse hammer will now indicate that soon the buyers will have control of the market, indicating a potential upward direction. Now let's understand how to trade with hammer and inverted hammer. So hammer and inverted hammer are bullish reversal patterns, meaning that we will have to rely on market trend, which should be a downtrend. So this would be one of the key trade setup. Additionally, while planning entry, our entry price should be close to the real body of hammer or inverted hammer, and our stop loss should be slightly below the lower wick of the candle. Last but not the least, you should always keep in mind your risk reward ratio and accordingly manage the quantities that you select for trading purpose. Now next in single candlestick patterns is hanging man. So hanging man is a structure which will look similar to hammer. The only difference being with the position where this hanging man candlestick pattern will appear. So hanging man will appear following an uptrend, and it is a bearish reversal pattern, meaning that the market direction will reverse after hanging man is seen on chart. Hangman, similar to hammer, will have a small real body, and there will be slight difference between the opening and closing prices. It will have a characteristic long shadow which will be at least twice the length of real body. The color of the candle does not matter. However, if candle is red in color, then it indicates a higher potential of market reversal and an incoming downtrend. Formation of hanging man candle, it indicates that bears have now entered the market and they are trying to create a downfall in the market. Now in the figure, we can see that there is an ongoing uptrend, meaning that the bulls are in complete control. A hanging man candle is seen at the end of uptrend, meaning that now bears have made an entry and they are trying to stop the further up move. So following the hanging man candle, you can now see that there is an induction of downtrend and you see red candles forming one after the other. So this is how hanging man will behave in your trade setup. Now let's see how do I trade with hanging man. So hanging man is a bearish reversal pattern, meaning our trade setup will depend on the previous market trend, which should be an uptrend. While planning entry, our entry price should be close to the real body of the candle and stop loss should be slightly above the upper wick or the upper shadow of the candle. Next is your shooting star. So this shooting star candlestick pattern is last on the list of your single candlestick patterns, and this is somewhat similar to inverse hammer. The only difference between inverse hammer and shooting star is the position at where this candlestick pattern appears. So shooting star, since it is a bearish reversal pattern, it is more effective when it follows an uptrend. So shooting star will appear at the end of an uptrend, and following shooting star, you will see that the market direction it reverses. So if there is an uptrend ongoing, market direction will reverse and you'll see an incoming downtrend. So the color of the candle, it can be green or red. However, when there is red candle, it indicates a higher potential of market moving in downward direction. The shooting star does not have a long lower shadow. Instead, it will have a long upper shadow where the shadow's length is twice the length of real body. And this longer wick, it indicates the bearish nature that is going to be introduced in the market. Since there is an uptrend in the market, it means that bulls are in complete control. The stock reaches its all-time high, and here, due to entry of bears, there is a downward push, and hence the price moves back to the opening price and it creates a long upper shadow, a long upper wick. So now let's understand how will I trade with shooting star. So here shooting star, since it is a bearish reversal pattern, meaning that the previous market trend should be an uptrend. So that's one of the key factors while trading with shooting star, that my previous market trend should be an uptrend. And when I'm planning my entry, the entry price should be close to the real body of the candle. And talking about stop loss, the stop loss should be slightly above the upper wick or upper shadow of the candle. With this, we conclude our single candlestick patterns.